All right, let's jump right in. Picture this. You're a foreign national and you've just sold your gorgeous Florida condo. You're feeling good, the deal is done, the price is locked in, but then, right as you're about to close, you get hit with a major surprise.
The buyer tells you they have to hold back 15% of the total sale price. And I mean the whole thing, not 15% of your profit. Your immediate reaction is probably, hold on a second, can they do that? Is this even legal? It feels off, but is it?
Well, the short and maybe surprising answer is yes. The buyer is 100% correct. And we're about to break down exactly why this happens, what the law says, and most importantly, what you can do about it.
First things first, let's look at this from the buyer's side. It might feel like they're trying to pull a fast one, but really, they're just protecting themselves. They have a serious legal obligation they absolutely cannot ignore.
It all boils down to one acronym, FIRPTA. That stands for the Foreign Investment in Real Property Tax Act. This law was put in place way back in 1980 for a really simple reason, to make sure the U.S. government collects taxes when foreign owners sell U.S. real estate. Before this law, it was pretty easy for sellers to just take the money and run without paying a dime in U.S. taxes on their profit.
Now, here's the clincher. To enforce this, FIRPTA does something clever. It makes the buyer the bad guy. The buyer literally becomes a withholding agent for the IRS in this transaction. If they fail to withhold that 15% from a foreign seller, the IRS can come after the buyer personally for the tax, plus all the interest and penalties. So you can see why they're not willing to take that risk.
Okay, so we've established the 15% is legit, but 15% of what exactly? This is where a lot of sellers get completely tripped up. The calculation is based on a term called amount realized, and trust me, it's bigger than you probably think.
You'd logically assume the tax is withheld on your profit, right? You know, the sale price minus what you paid for the place and any other costs. But nope, that's not how FIRPTA works. The withholding is calculated on the amount realized, which is the full sale price plus any mortgages or other debts the buyer is taking over. It's the whole shebang.
And this part really catches people by surprise. All those selling expenses, like the real estate agent's commission, your legal fees, closing costs, you can't subtract any of that from the sale price before calculating the 15%. It's based on that big, gross number, period.
Now, hearing all this might have your head spinning. I get it. A 15% holdback is a huge chunk of cash. But don't panic. The situation is not hopeless. There are a few legit ways you might be able to reduce or even get rid of that withholding. Let's walk through them. Generally speaking, you have two main options. The first is a very specific exception that depends on the sale price and what the buyer plans to do with the property. The second route involves a more formal application process directly with the IRS. So let's look at option one, the personal residence exception. It's all about the price and the buyer's intent. If your sale price is $300,000 or less and the buyer signs a legal document saying they're going to live there, then boom, the withholding drops to zero. If the price is between $300,000 and $1 million and the buyer still plans to make it their home, the rate gets reduced to 10%. But if the sale price goes over $1 million, this exception is off the table. You're back to the full 15%, no matter what the buyer's plans are.
So what happens if you don't qualify for that exception? Well, your next best bet is to apply for a withholding certificate from the IRS. You do this with a form called A288B. This is perfect for situations where your actual tax bill is going to be way less than the 15% withholding, say if you have a very small gain or even a loss. You have to file this on or before your closing date. The buyer still hangs on to the 15%, but they just put it in an escrow account instead of sending it right to the IRS. Then you wait for the IRS to make a decision, which usually takes around 90 days.
Now we need to talk about deadlines because they are no joke. Unless you've applied for that withholding certificate, the buyer has just 20 days, 20 from the closing date to send that withheld money to the IRS. This super tight timeline is another big reason why buyers and title companies are so strict about this whole process.
And this brings us to what is, without a doubt, the single biggest misunderstanding in this entire process. Even after the buyer has withheld the 15% and sent it off to the government, you are not finished. This is the final tax trap that so many foreign sellers fall right into.
Please, hear this loud and clear. That 15% withholding is not your final tax payment. Think of it more like a mandatory deposit or a prepayment on your estimated tax bill. To figure out what you actually owe on your profit and to settle your account with the IRS, you are still legally required to file a U.S. tax return, specifically a Form 1040-NR for the year you sold the property.
This chart shows you exactly why filing that return is so critical. Let's imagine you had a $500,000 capital gain. The 15% withholding is $75,000. But depending on your tax bracket, your actual tax rate could be much higher, maybe as high as 37%. In that case, your real tax bill is $185,000. That means you still owe another $110,000. The withholding didn't even cover half of what you truly owe.
So, once you file that 1040-NR tax return, one of two things is going to happen. If the 15% they withheld was actually more than your real tax bill, great. The IRS will send you a refund. But like in the example we just saw, if your actual tax is higher than what was withheld, you'll have to pay the difference. If you don't file, you can't get a refund you're owed, and you'll be on the hook for penalties and interest if you underpaid.
So we'll end with this one final, crucial question. That withholding at closing, it's just step one of a two-step process. The buyer did their part, but step two, filing your return and settling your final tax bill, that part is all on you. So, have you taken that final necessary step?